Okay, ever wonder what's really going on inside a company? I mean, beyond the cool products and the splashy headlines? Well, the secret? It's all in their financials. And today, we're going to learn exactly how to read them. So, you see a company, right? Everyone's talking about their new gadget, revenues are through the roof. You think, wow, they must be absolutely crushing it. But, that's not always the case. The real story, the true health of that company, is written in a language that, believe it or not, anyone can learn to read. Here's the best way to think about it. Imagine a company is a person, and just like a doctor checking a patient's vital signs, heart rate, blood pressure, investors and business owners use three key reports to diagnose a company's financial health. We're about to look at that medical chart.
All right, let's dive into that checkup. We're looking at a company's financial vitals, the three core statements that tell us, well, pretty much everything we need to know.
And here they are, our three key reports: the balance sheet, the income statement, and the cash flow statement. Now, each one tells a different part of the story, but they are all absolutely crucial. Okay, first up, the balance sheet. I always think of this one as the company's annual physical. It's not about the whole year, it's a snapshot. It tells you exactly where things stand on one specific day. Right. It's a financial snapshot. It doesn't tell you what happened last month or last year, but what the company's financial position is right now at this single point in time. And it's basically broken down into two main parts: what a company owns and what it owes. So on one side, you've got your assets. This is all the stuff the company owns that has value. We're talking cash, the inventory in the warehouse, even the factory equipment. Then on the other side, you have liabilities. Pretty simple. This is all the money the company owes to other people. Think bank loans or maybe bills they haven't paid yet. And here's where it all comes together in one single super important equation. Assets equals liabilities plus equity. Now, a company's assets always have to equal its liabilities plus its equity. So what's equity? Well, think of it this way. If you sold off all the assets and paid off all the liabilities, the money left over, that's the equity. It's basically the company's net worth. Okay, let's see this in action. Here's a simplified balance sheet. You can see assets are split into current, stuff you can turn into cash pretty fast, like inventory, and non-current, which are your long-term things like buildings. You add those up and you get total assets of $214,000. Now look at the other side. Total liabilities plus shareholder equity. What do you know? It's also $214,000. They have to match. They have to balance. And that's exactly why it's called a balance sheet. So if you remember one thing about the balance sheet, it's this. The key question it answers is, what is this company's net worth on this specific day? That's it. It's the bottom line measure of what the company is actually worth. All right, on to vital sign number 2. If the balance sheet was a snapshot in time, then our next report, the income statement, is more like a video. It's the performance test. It shows you what happened over a period of time, say a quarter or even a whole year. Yeah, this is the one that tells the story of how the company did financially. Did they actually make a profit, or did they end up in the red? It's all about revenue, expenses, and profit. And it always starts with the money coming in. That money coming in, we call that revenue. So for this company, they brought in over $28 million from selling their stuff. That's what we call the top line. But hey, as they say, you gotta spend money to make money. It cost this company almost $18 million just to produce the things they sold. That's the cost of sales. So you take the revenue, you subtract what it costs to make the product, and what are you left with? You get the gross profit. Now, this isn't the final profit, but it's a huge deal. It's the profit they made just from their core business of selling stuff, before you even think about things like marketing or rent. Now, you might see these things presented a couple of different ways. Sometimes it's a simple single-step format. Other times it's a more detailed multi-step. Honestly, don't get too hung up on that. The destination is always the same. You start with revenue at the top, you subtract all the costs and expenses, and you get to the most famous number of all, the bottom line, or net income. So for the income statement, the golden question is super simple. During this period, was the company actually profitable? Did they make more money than they spent? That's what it all boils down to. Okay. This brings us to our third and final vital sign. And some people argue this is the most important one of all. It's the cash flow statement. If the balance sheet is a physical, this is the EKG. It's tracking the actual lifeblood of the business, cash. So what this statement does is show how cash is moving in and out of the company. It's broken down into three main activities. First, operating. That's cash from just the normal day-to-day business. Second, investing. This is cash used to buy or sell big assets, like a new building. And third, financing, which is cash from, say, getting a loan from a bank or selling stock to investors.
But wait a second. You might be thinking, hold on, if the income statement shows a company is profitable, doesn't that mean it has a ton of cash? It is a fantastic question, and the answer is a huge, emphatic no. Not at all. And this is exactly why this statement is so important. A company can look super profitable on paper, but totally run out of actual cash to pay its bills. Think about it. They make a huge sale, so it looks great on the income statement. But if the customer bought on credit and hasn't paid yet, there's no actual cash to pay salaries. This statement, the cash flow statement, shows the real cash story.
So now we see how they're all different, right? We have the snapshot, the performance test, and the EKG. But the real magic, the full picture, only comes when you see how they all connect and talk to each other.
And they're all interlinked in this really elegant way. That net income, the bottom line from the income statement, that flows into the equity section on the balance sheet. And the cash flow statement, it perfectly explains the change in the cash balance on the balance sheet from the beginning of the year to the end. It's like a giant puzzle where every piece fits.
So there you have it. By understanding these 3 simple statements, you can now read the vital signs of any company. You've basically learned the language of business. So now that you have this superpower, which company's health are you going to check first?